All right, so we're back again here. My name is Joe Scotti in Wealth Management with Shaw & Sons. Here we have Sagar Shah, the CPA of the firm. And today we're going to be covering a topic that's pretty familiar to a lot of our clients.
Yeah, so literally just like 20 minutes ago was talking about this with a client who, like Joe said, almost every client interaction, at some point somebody asks the question, how do I write off a car, or should I buy a car through my business? And then with the times right now, should I lease or should I finance my vehicle? Typically, we ask 4 questions of the client before we start guiding them in a specific way, because everybody's situation is different, right? There's no, even with the things we talk about in here, one of the things you'll see is every situation requires analysis for your particular circumstances and how we're going to, maximize what your goals are, right? If you're somebody who is looking to go buy a new house, you're probably not taking every deduction that you can possibly think of. You're kind of just showing a clean set of financials, showing your income and your expenses related to your business. If you're somebody whose main goal is to save as much as you can on taxes and take every advantage of the tax law as possible, you may not be trying to buy a property because that's probably not putting you in that ability to do that. So whenever a person comes and asks us, should I buy a new vehicle, or how do I buy a new vehicle, you got to always find out about your client.
Yeah, and that's going to be the topic of today, right? Is everything about vehicles. How, does it make sense for us to buy one or lease one? What is it, the difference between business and personal? If I'm selling a vehicle, how do the taxes work? And the different methods in order to deduct. So I think where we can start really is, business versus personal, right? How does that work from a commuting standpoint? And then we can kind of take it from there.
So I would even take a step back from there and say, I want to know 4 things about the vehicle that we're looking to purchase, right? The first one is it gas or electric? The second one is, are you using this for business use? Can you use it for business use? Are you somebody who has their own business that requires driving for work? Or are you using this more as a personal vehicle? Are you somebody who has their own business, but you work from home and you don't really drive for work, right? Is there even a point at that point of buying a business vehicle? And then the complications from that standpoint. 3, are you buying used or new? And that affects how much you can depreciate in a given year. And then the last question is, how many miles are you expecting to drive? This doesn't even factor in things like the cost of the vehicle and doing analysis from that standpoint. But those are typically the 4 starting points. And you mentioned the business versus personal, and that's probably a good place to start for this. I just want to quickly touch on the electric versus
let me say, so if you're someone who's driving consistently for work, you should probably have a conversation with your accountant on 100%. I'm buying a new car, should I lease it, should I buy it, how many miles can I write off? That's number 100%. One. Those 4 things need to be known from your accountant
100%.
standpoint.
And your accountant should be asking you these questions, otherwise he's not giving you maybe the right analysis on what's optimal for you. So electric vehicles, great tax credits were in place for a long period of time. 2025, a lot of that is expected to sunset. Depreciation, expenses, costs, everything else is pretty much the same between an electric vehicle and a gas-powered vehicle when it comes to taking deductions and write-offs, except for the credit, right? The one clean energy credit. You can either do it through your business, you can also do it through your personal. There's different ways to go about getting those credits. However, most of those are going away. The new version of the Build Back Better bill, which is not passed as of the date of this video. It is not passed yet, but it's not in there. The actual electric tax credits are set to sunset anyway in the next few years, and there's income cap limits on most people. I think it's 179,000 last year. So once you're over that income cap, you're also not getting the credit. So nice to keep in mind, might be a little extra additional, something you can get on top. We've seen leases that people get into where they are able to get the financing company or the dealership to actually give you the credit in the form of reduced monthly payments. Things like that, obviously exist. But in this particular case, we're kind of just saying be aware of it if you're going to go the electric route and make sure you're getting those credits or trying to maximize your ability to take the credit. But for the most part, for these calculations and the ways we're going to dump in, we're going to look at mostly gas-powered vehicles. So that was question number 1. Question number 2 then goes to, is it business use or personal use, right? And I think this is a very simple, straightforward thing where we'll talk about the lease versus financing things that come into this on a personal standpoint, which can still be helpful for you. But the deductions, 99.9%, if you don't have your own business, if you don't have either 1099 income or a property management company or a 1065 or an LLC that you're filing for your returns, you're not going to get most of the deductions that we're going to discuss. So, as we said, vehicle, business versus personal. Very simple, straightforward thing here. If we're taking tax deductions on your business, you need to be using the car for business related work. Anything you do that is not business related, you are responsible for keeping track of those non-business miles and then either not taking that deduction, using a percentage of the deduction that we're supposed to be talking about, or picking it up as income for yourself as a fringe benefit of using this vehicle. So generally speaking, you don't want to be using this deduction on a car that is sitting there, that's a very high-end car that you're using for personal use only. You're driving it maybe once a week. This is not the type of deduction to use that car for. This is for something that you're using every day for work, that you're driving to work, that you're carrying materials with you. Those are the types of things you want to be taking for the deduction here. Otherwise, there's a lot of people online that tell you, take these deductions, you could do this, you could do this, you could write it off, the 179. Yeah, until you get audited, and in reality at that point, you're basically looking at potential tax fraud for taking these deductions. So
or paying back all the deductions that you took.
Correct. Right now, generally speaking, that doesn't, we don't see that happening with our clients because we make sure that everyone is prepared for if there is an audit, that they are done things the right way. But if it does happen to you, we want to give you the things you need to keep in your back pocket to prevent a negative audit outcome.
So let me give you an example. So we own a construction company. You have a pickup truck, and let's say we're getting to this point, but let's say your office is technically your home. You're driving to all these projects. You're driving back, but then for personal use, you drive to the grocery store. You pick up groceries. You come back with it. Where do you really draw the line between how much of it is business and how much of it is personal? And then how would the IRS even really know that?
Like with all things related to the IRS, this is your responsibility, and they're going to assume you're lying about everything.
Okay.
So they're going to say none of your miles are business miles.
Prove it.
And you prove it to us. So we've told clients to use an app called MileIQ.
Okay.
It's a very simple thing you can do. You download it. It tracks your GPS, and you once a week indicate whether this was miles for work or personal. You can keep a log book, a record book, where you're writing down your miles on a regular basis. But no matter how you slice it, at the end of the day, whatever tools you use, it's your responsibility to keep track of your miles and to prove that you're driving this car mainly for work so that you're able to take the deductions that we're talking about here. To jump into how you take the deductions.
Yeah.
Right? You got two ways of doing it, right? The first one is the standard way, which is you take 67 cents for every mile that you drive. Now, this is something that is very powerful for the person who doesn't like fancy, shiny new cars and wants to drive something reliable for 10, 15 years. This is a great way of keeping track of your miles. Every time you drive your car, every time you have business mileage, you keep it in that logbook, or you use one of these apps. We're not giving any free promotion here, but MileIQ is one that's very popular for this. You keep track of your miles. You get 67 cents for every mile you drive. You drive 10,000 miles, $6,700 you're taking as a deduction off your business account. If you have a car that's already fully paid off, you put 20,000 miles on it a year. Right there, you're taking $13,000 that you can take as a tax deduction off that 20,000 miles that you're driving, and it's costing you nothing because you already own the car. This is a great method for people who are very conservative in their spending and don't have a lot of expenses related to their vehicles. The other one is for guys like me and Joe who actually do end up spending way too much on their cars. You take the actual expense method. You keep track of all your different costs associated with the vehicle. You keep track of your miles, as well as your gas, your insurance, your repairs that you do on the car. If something breaks on the car, that becomes deductible now because it's a business asset. Your tires, your general maintenance, your lease payments, as well as the associated interest with it. If you pay a yearly registration fee to the state, you can take that as a deduction as well. Keep track of all that stuff. As always, the number one tip for everybody, keep all your expenses on one card that's related to your business. Don't mix personal and business cards together. The reason why is because at the end of the year, you don't have to start thinking about, wait, did I go and fix my bumper, or did I have to change a set of tires? You've already used your business credit card, so when your accountant or your team is doing your books at the end of the year, they're able to see these expenses and allocate them appropriately. So keep track of all those things, and you can take all of those deductions at the end of the year.
So you said, so for a standard mile, someone who likes a reliable car, someone that they're going to drive for 10, 15 years, this is a great model. For the more bougier people that want a nicer car, right? This benefits more because there's probably going to be more repairs due to it, or
more
it's
costs.
more expensive in order to do it.
Sure. Yeah. Exactly.
Yeah.
Right? Like if my lease payment on my car is $1,000 a month.
Right. Much different than a reliable.
And I have zero on my other car.
Okay.
Right?
Yeah, that makes sense.
And I'm driving, let's say, 7,000 miles a year for work. My 7,000 at 67 cents is what, like 5,000 something dollars?
But the expenses are going to be higher.
Versus it's 12,000 just on my lease for the more expensive car.
Okay.
So the more expensive your car is, like, unless you're driving hundreds of thousands of miles or 20,
so that
50,
leads into my next
70,000,
question,
yeah.
right? So obviously you're keeping track of all of your expenses regardless, and then at the end of the year, I'm assuming you can more than likely decide, all right, well, 67 cents the mile. This is how many miles I drove. It's actually more than what my actual expense especially would be. Is there opportunities for you to switch between the two, and how do you do that?
Yeah, no, so they've thought of this.
Okay.
And I know where your brain is going to head to next, which is, all right, well, what if I buy a really expensive car right now, finance it for 5 years, but I'm going to keep it for 10 years.
Right.
And then I switch to the standard after my first 5 years when all my expenses have gone.
Right.
And now I have no more costs, and then I start using the miles.
The standard mile.
You cannot do that.
Okay.
Right? So you can switch, but you can only switch from standard method to actual expense method.
Okay, so you can't start an actual and then go to standard.
No, if you start with actual, you have to stick with actual for the life of that car.
Okay,
right?
So you're 3 years into the lease. You've been using actual the whole time. Now you're getting another car. Now it's a restart. And maybe your job has just demanded you to drive more than it did before.
Yeah.
So now you got to project out, all right, maybe do we start with standard for the first year, and then we say, all right, your expenses were higher.
Definitely. And that's definitely something you do with that's one of the exercises you do with your accountant. That's one of the things you look at to make sure you are, getting the maximum benefit and the maximum deductions. So I can see a situation where, let's say you are taking the standard and now you have a year where unfortunately you have a bunch of expenses for your car. Something breaks.
Right.
That might be a year you switch to actual.
And then once you switch to actual, there's no going back.
But now you're stuck with actual.
Okay, all right, I got you. So ideally, you buy you get something that you own and you're driving a decent amount, you're going to use standard for as long as possible until you start having those repairs, you start having some of those other concerns. That's when you change to that.
Correct. And, the idea is generally you want to stick with the same thing forever. That's like one of the rules of accounting is you're not switching the way you're calculating stuff. You're consistent every year. This allows for one-time switch to actual, but you want to make sure that it's worth it when you do it. And then, like you mentioned, different cars, buy a new car, you can change the way you're
start the process over
for that specific vehicle differently.
I mean, I might be jumping ahead of it, right? But one of the questions that kind of came to mind is you have multiple cars that are for business, right?
Okay.
Or let's say you're married and your wife works with you for the business. Would you be more leaning towards covering one car specifically, or would you have the ability to cover two if you both work for the business?
No, I think you go based on the reality of the situation, right? If you and your wife are both working in the business and you and your wife are both using your vehicle for the business.
We're both realtors. So if she's at one house, I'm at one house. We consistently do it that way.
Then you should be writing off both cars.
Then it would make sense, write off both.
Right?
Okay, got it.
You should be writing off both cars. You should be making it, once again, you're tracking your business versus your personal.
Right.
And if you don't have a personal vehicle and you only have business vehicles, that cannot be true.
Right.
Nobody is not driving at all for their personal, only driving for work. Maybe 1 in a million people is like that.
Gotcha.
So generally speaking, if you only have business vehicles, both you and your wife, you only have 2 cars at home, and you're both saying you're using it for work, you better be at the end of the year telling me how much of those miles you're driving are for personal use.
Right.
So that we can pull those out.
Because there's no way you're not using it for personal. Right.
100%. So where that leads to next, right, is we're buying the vehicle. Let's say it makes sense for you to get it through your business. A question I get all the time. Should I own my vehicle through the business or through my personal name? And generally people ask me that because insurance is higher when you hold it through your business.
Yeah.
And they're, these are people that are trying to not, just
cut
smart
the corner
clients.
as much as possible.
Yeah, exactly. But they don't want to pay the extra insurance, right? You want to write off the whole car, that $75,000 car, but you don't want to pay the extra $1,000 of insurance per year,
right?
Which, more power to you, but you can't do that, right?
Right.
If you're buying the car, you're depreciating the car, you're writing it off through your business has to own it. It doesn't make sense for you to personally own a car that's being depreciated from your business logically and legally. But lease is different. Now, you can do subleases, and that's something that does exist where you purchase a car or you lease a car personally and then lease it from yourself as a sublease to your business.
Okay.
Those things do occur, right? And there's rules that govern it, but that's a potential option where, hey, I really don't want this thing in my business's name. I want it in my personal name. Here's an option where you can do this. But generally speaking, in the name of the business, always insurance goes through there. Insurance becomes deductible now. So yeah, you may pay a little more, but now you get to write off your entire insurance payment.
Right.
That's an important rule that people need to keep in mind.
So let's say we own it now.
Yeah.
We're buying the car. How does it work when we want to resell it in the future, or maybe after 3 years we're sick of it? What are the tax benefits of owning it compared to leasing it?
Yeah. So what'll happen is, and this is something that you never hear this portion of it, unfortunately, from a lot of the TikTok gurus and the Instagram, tax guys who are not really tax guys because they're not licensed. What they'll typically say is, oh, well, you could take this whole deduction. Isn't this great? You can write off your whole G-Wagon,
right?
Your $200,000 purchase. It all becomes deductible. It's like, yes, it's true. You do get those deductions, but when you want to sell the car, it's now a taxable consequence to you, right? Selling that vehicle on the open market or trading it in at a higher price point, you've written this car to zero. You're now selling this car for a number above what you've told the government it's been written down to. That means you have a taxable consequence.
Right.
Now, there's things we can do to plan around that and to avoid the tax consequence. Or really, if you're purchasing a new car and you're trading this car in and we're using the depreciation rules properly, you should be able to wipe away that gain that comes in. But when you take an expense and then you try to cash that thing in the future, saying it's not worth zero, there's always going to be a tax consequence, and that should be in the back of your mind while you're doing a lot of this analysis of what type of car to buy and when to buy. And if you have a current tax consequence on trading in your car right now, if you're looking to buy something. Speaking of depreciation, right, there's a multiple different ways of calculating depreciation for the vehicle. There's the Section 179 that everybody talks about, right? That's that 6,000 pound rule that you've probably seen. If a car weighs more than 6,000 pounds, you can take a bunch of that off right away. Erroneously, people seem to think if my car weighs more than 6,000 pounds, that means I can write off all of it. That's not true. There are specific caps, but we use Section 179 along with other types of depreciation like bonus depreciation, Macker's depreciation. That will sometimes allow you to take the entire car as a write-off. It's just about how you structure it and how you use it. And you may get all of it, you may not get all of the deduction. And something that I always talk to people about is, do you even want all of the deduction? I was going to say,
you may not even need it for the whole year.
Yeah, you may not even need it.
Save some for next year.
You may not even want it, right? Like if you're making, let's say $200,000 a year that you're going to pay tax on after all your expenses.
Right.
And you have a car that's worth $100,000 that you're going to buy this year. I probably would tell you not to write off that full $100K because you're going to be dropping a tax bracket in between this entire exercise. So you're going to go from having a 24% tax bracket to potentially an 18% tax bracket. So you took that extra deduction on that vehicle, but because you dropped the tax bracket, you lost a little bit of that value on that loss. If you're somebody who's making $5 million a year, sure, take all of it because everything's getting taxed at the highest possible tax rate. Right. Every dollar of expense is giving you the maximum amount of deduction back. But this comes back into time value of money. This goes into what's the right strategy for you. Would I rather take 20% of the car over 5 years and take those deductions at the highest tax bracket? Or would I rather drop into a lower tax bracket or 2 tax brackets lower and take the entire car as a write-off and maybe not get as much, juice out of the squeeze, but get my money up front? So once again, this is person by person dependent and something you should be looking at. How much of a bracket am I dropping in? Am I getting this deduction at 32% or am I getting most of this write-off at 18% or 12%? In those cases, you may want to defer some of those losses and expenses to future periods and wipe away future income that's going to be coming in. We talked about this Section 179 that everybody talks about, or it's like, oh, my car weighs more than 6,000 pounds, I can write off the whole car. It's just absolutely not correct. First of all, you can use bonus depreciation if your car is less than 6,000 pounds. You get capped at 12,200 of bonus plus the accelerated depreciation. It depends on the percentage, depends on the year, depends on if these new tax laws pass. If they pass, you could take 100% of the car as a write-off without using any of your bonus depreciation, save it for something else. But as of right now, with the current Mackers laws and the current breakdowns, this is what 179 shows. You get 12,200 if your car is less than 6,000 pounds. You get 28,900 if your car is more than 6,000 and less than 14,000 pounds. You're going to get some bonus depreciation on top of the regular depreciation you get, which standard depreciation straight line. So divide the car by 5, you get 20% of the car every year. So divided by 5, whatever that number is, you get that. Then add on top of that, if it's less than 6,000 pounds, another 12,200 for the first year or 28,900 for the first year. Then there's accelerated depreciation, which depending on the year could be 40% for 2025. If you're restating an old tax return, which you're also able to do, if you bought a car in 2023 and you never knew about this and you never took advantage of this, you can go back and take the 2023 rate, which was 80%. So lots of different things that factor in making sure you're aware of these different calculations, which, just trying to give you the knowledge that you can either put in for this or hire an accountant or, click the Calendly link below and schedule a time for us to look at your numbers. I think another important thing that, beyond just the calculations and something that we really want to stress here is just a quick recap, right? You want to make sure your record keeping is on point, that you're keeping track of your miles, that you're keeping track of your expenses, you're keeping track of everything so that you can make the decision to use that standard or the actual for that first year.
And you can prove to the IRS if they say, hey, we don't believe you, we need to see it.
Exactly. Another little tip, right? So for example, my office, I own the business. I can't deduct my commute from my house to here. Joe works for me. And Joe was a 1099 contractor and his home office was his main office location. Every time he comes into work during our contracted period, that's a deduction for him because he's driving to a secondary place of work where his main place of work is his home office. That's something that's available and something that's possible for you to do.
So could you, if you had a home office that you wrote off for tax purposes in your 1099, that would constitute as your main office. You wouldn't be able to have multiple, right? Let's say you have an office that you work out of and then you have a home office. How do you distinct between the two if you're driving different places? Would you have to pick one? Or?
So it depends on how you work for this, right? If you have a business that has a physical location and that is an office that's rented by your business and you are driving to that office, that's a commute.
Right.
That is not a business travel.
Okay, right, got it.
Now, if you contract with another company for a 2-year period, every time you drive to that office, if you're a 1099 contractor and you're, have to be there based upon your contract, that would be deductible
from the office
miles.
to there. Okay.
Correct. From your home office to there.
That's what I was going to say. Yeah. So you have a home office deduction, it should go from your home. Got it.
Correct. What about if you have multiple businesses? Right? If you have multiple businesses, your car can be used for multiple different businesses. You don't have to have a different car in each business.
And is that beneficial? And having multiple businesses when you're using the car for a deduction standpoint?
Your actual expenses are your actual expenses.
Right.
Your miles driven are your miles driven. So you're not going to get a double benefit, but you don't have to worry about the fact that, hey, I purchased this vehicle through this business. I have another business that I need to use this car for. That other business, if you're using assets, it should be paying a fee as a deductible expense and taking that expense.
Right.
So multiple businesses is irrelevant on whether or not the car is used for those different businesses. You just have to keep track. You just have to have good records. And then, you mentioned this with what if me and my wife have, both work at a business.
Right.
Yeah. If you both are using your vehicle, you both should be taking those expenses. You both should be writing off your vehicle through that company. But you should also be cognizant of the fact that if the government comes and asks me about my personal miles, I'm hoping that you've been tracking those personal miles.
Right. You can distinct the difference between the two.
100%. And then people say, hey, do I have to wrap my car? Do I have to put my advertising on it? Do I have to put my company's name on the car? No. You don't have to do any of that. You can.
Is it beneficial if you add it?
It might help talking to the
obviously
IRS,
helpful. Okay.
right? The company name is on there.
Look, here's the sticker. I'm promoting at the same time.
I put a sticker on my, on a 911 Turbo. That doesn't make it a business expense.
Right.
All it means is I, made my car uglier. So at the end of the day, the reality of the situation is what dictates your expense, not putting a sticker on a car. Thank you guys for listening in. And
thanks for joining. Look forward to our next one.
yeah, if you have questions or things you want us to talk about in the next video, please leave it in the comments and we'll absolutely take a look and try to address whatever questions and comments that we see coming up.
Great. Thanks, guys.